Execution of forward contract. A customer under forward contract, known as advance the time and amount of foreign exchange to be delivered, and the customer is bound by this agreement. There should not be any variation, and on the due date of the forward contract, the customer will either deliver or take delivery of the fixed sum of foreign exchange agreed upon. But in practice, quite often the delivery under a forward contract may take place before or after the due date, or delivery of foreign exchange may not take place at all. The bank generally agrees to this variation, provided the customer agrees to bear the loss, if any, that the bank may have to sustain on account of the variation. Though the delivery or take delivery of a fixed sum of foreign exchange under a forward contract has to take place at the agreed time, quite often this does not happen. It may either take place before or after the due date agreed upon. However, the bank generally agrees to this variation, provided the customer bears the loss, if any, on account of this variation. Based on the circumstances, the customer may end up in any of the following ways. Number 1, delivery on the due date. Number 2, early delivery. Number 3, late delivery. 4, cancellation in the due date. 5, early cancellation. 6, late cancellation. 7, extension on the due date. Number 8, early extension. Number 9, late extension as per the Rule 8 of FIDI. A request for delivery or cancellation or extension of the forward contract should be made by the customer on or before its maturity date. Otherwise, a forward contract which remain unutilized after the due dates become an overdue contract. Rule 8 of FIDI stipulates that the bank shall levy a minimum charge of Rs. 100 for every request from a merchant for early delivery, extension, or cancellation of a forward contract. This is in addition to the recovery of actual loss incurred by the bank caused by this change. Delivery on due date. This is the situation envisaged when the forward contract was entered into. When the forward exchange is delivery on due date, the rate applied for transaction would be the rate originally agreed, irrespective of the spot rate prevailing. Early delivery. When a customer requests early delivery of a forward contract, i.e. delivery before its due date, the bank may accede to the request, provided the customer agrees to bear the loss, if any, that may accrue to the bank. The various operations involved may be summarized thus: with customer, with market. 1st April. A. Sell forward due June. B. Buy forward due June. 1st May. C. Sell in execution of AD. Buy spot to accomplish. C. E. Sell forward due June to dispose and dispose the proceeds. B. 1st June. F. Receive delivery under B. G. Delivered proceed of F in execution of E. On 1st May, the bank makes a spot for keys and forward sale of the same currency for the same value. The difference between the rate at which the currencies were cased and sold in a swap deal is the swap difference. The swap difference may be a swap loss or swap gain, depending upon the rate prevailing in the market. If the bank buys high and sell low, the difference is swap loss recoverable from the customer. If the bank buys low and sell high, the difference in the swap gain payable to the customer. On 1st May, the bank receives rupees from the customer on sale of foreign exchange to him. It's pay a rupee to the market. The spot for keys made. If the amount paid exceeds the amount received, the difference as present outlay of funds. Interest on outlay of funds is recoverable from the customer from the date of early delivery to the original due date at a rate not lower than the prime lending rate of the bank concerned. If the amount received exceeds the amount paid, the difference present inflows of funds. At its discretion, the bank may pay interest to the customer of inflow of funds at the appropriate rate applicable for terms deposits for the period for which the funds remain with it. Charges for early delivery were comprised of swap difference, 2 interest on outlay of funds, and 3 flat charges or handling charges RS 100 minimum. Important note: in the deal with its customer, the bank is the market maker and the transaction is talked of as for case or sale from the bank's point of view. When the bank deals with the market, it is assumed that the market is the market maker. Therefore, the market rates are interpreted with the market buying selling the foreign exchange. The bank can buy at the market selling rate and sell at the market buying rate. Extension of a forward contract. The customer is having the right to cancel and forward contract at any time during the currency of the contract. The cancellation is governed by Rule 8 of the FDI. The difference between the contract rate and the rate at which the cancellation is done shall be recovered or paid to the customer if the cancellation is at the request of the customer. Exchange difference not exceeding Rs 50 shall be ignored. The spot rate is to be applied for cancellation of the forward contract on due date. The forward rate is to be applied for cancellation before due date in the absence of any instruction from the customer. Contracts which have matured shall on the 50th day from the date of maturity be automatically cancelled. If the 15th day falls on a holiday or Saturday, cancellation will be done on the next succeeding working day. The customer is liable for recovery of cancellation charge. In no case the gain is passed on to the customer since the cancellation is done on account of customer default. The customer may approach the bank of cancellation when the underlying transaction becomes infraction or for any other reason he wishes not to execute the forward contract. If the underlying transaction is likely to take place on a day subsequent to the maturity of the forward contract already booked, he may seek extension in the due date of the contract. Such requests for cancellation or extension can be made by the customer on before the maturity of the forward contract. Cancellation of a forward contract on due date. When a forward forecast contract is cancelled in the due date, it is taken the bank forecasts at the rate originally agreed and sells the same back to the customer at the ready-dt rate. The difference between these two rates is recovered from paid to the customer if the forecast rate under original forward contract is higher than the ready selling rate. To the difference is payable to customer. If it is lower, the difference is recoverable from the customer. The amount involved in forecast and sale of foreign currency are not passed through the customer account. Only the difference is recovered paid by way of debit credit to the customer account. In the same way, when a forward sale contract is cancelled, it is treated as if the bank sells at rate originally agreed and buy back at ready buying rate. The difference between these two rates is recovered from paid to the customer. Example, a forward sale contract for French franc 2050 for an import customer on 50th March for delivery on 50th April at Rs 7.0450. The customer requests for cancellation of the contract on the due date. The following information are available. French francs were quoted on London Foreign Exchange Market as under spot USD 1 equals FRF 6.200 to 300. 1 month 305 to 325, 2 months 710 to 760. The US dollar were quoted on the local interbank exchange market on the date cancellation is follows. Spots USD 1 equals Rs 42.2900 to 2,975. Spot May 3,000 to 3,100. Spot June 6,000 to 6,100. Exchange margin required is 0.10%. What will be the cancellation charge payable by the customer? Solution. The sale contract will be cancelled at the ready buying rate. Dollars, rupee, market buying rates equals RS 42,2900 less exchange margin at 0.10% equals RE 0.0423 RS 42,2477. Dollar franc market spot selling rate equals FRF 6.300 TT buying rate for franc 42,2477 to 6.300 equals RS 7.62. Rounded off, the applicable rate is RS 7.50. Franc sold to customer at equals RS 7.0450. Now bought from him at RS 7.0050. Net amount payable customer per franc RE 0.0400. Therefore, at RE 0.0400 per franc, the customer has to pay RS 10,000 for FRF to 50,000 by including flat charge of RS 100 on cancellation. RS 10,100 will be recovered from the customer. Early cancellation of forward contract. Sometimes the request for cancellation of a forward forecast contract may come from a customer before the due date. When such requests come from the customer, it would be cancelled at the forward selling rate prevailing on the date cancellation. The due date of this sale contract is synchronized with the due date of the original forward forecast contract. On the other hand, if a forward sale contract is cancelled earlier than the due date, cancellation would be done at the forward forecast rate prevailing on the with due date of the original forward sale contract. Extension on due date. An exporter find he is not able to export on the due date but expect to do so in about 2 months. An importer is unable to pay on due date but it's confidence of making payments a month later. In both these cases, they may approach their bank with whom they have entered into forward contract to postpone the due date of the contract. Such postponement of the date of delivery under the forward contract is known as the extension of forward contract. The earlier practice was to extend the contract at the original rate quote to customer and recover from him charges for extension. The Reserve Bank has directed that with effect from 16.1.95, when a forward contract is sought to be extended, it shall be cancelled and rebooked for the new delivery period at the prevailing exchange rate. FIDI has clarified that it would not be necessary to load exchange margins when both the cancellation and rebooking of forward contract are undertaken simultaneously. However, it is observed that the bank do include margin for cancellation and rebooking as in any other case. Further, only a flat charge of RS 100 minimum should be recovered and not RS 250 as in the case of booking a new contract. Overdue forward contract. As we had already seen, the customer has the right to utilize or cancel or extend the forward contract on or before its due date. No such right exchanged after the expiry of the contract. FIDI Rule 8 provides that a forward contract which remain overdue with any instruction from the customer concerned on or before its due date shall on the 15th day from date of maturity be automatically cancelled by the bank. The customer remains liable for exchange differences arising therefrom, but if it results in profit, it need not be passed on to the customer. In case of delivery subsequent to automatic cancellation, the previous rate current rate prevailing on such delivery shall be applied. Rollover forward contract when deferred payment transaction of imports, export take place, the repayment of the installment and interest on foreign currency loans by the customer required long-term forward covered where the period extends beyond 6 months. The bank may enter into forward contract for long terms, provided there is suitable cover is available in the market. However, the cover is made available on a rollover basis, in which cases the initial contract may be made for a period of 6 months and subsequently its deferred installment for the outstanding balance of forward contract by extending for further periods of 6 months each. For this transaction, the rules and charges for cancellation extension of long-term forward contract are similar to those of other forward contracts. Interbank deals. Foreign exchange transaction involve transaction by a customer with a bank, while interbank deals refer to purchase and sale of foreign exchange between banks. In other words, it refers to the foreign exchange dealings of a bank in interbank market. Cover deals. The bank deal with foreign exchange on behalf of its customer. Purchase and sale of foreign currency in the market undertaken to acquire or dispose of foreign exchange required or acquired as a consequence of its dealing with its customer is known as the cover deal. In this way, that is truth cover deal, the bank gets insured against any fluctuation in the exchange rate. While quoting a rate to the customer, the bank is guided by the interbank rate to which it adds or deducts margin and arrives at the rate it's quotes to the customer. For example, if it is buying dollar from the customer special, it takes interbank buying rate, deduct its exchange margin and quotes the rate. This exercise is done on the assumption that the immediately on purchase from customer to the bank would sell the foreign exchange to enter the bank market at market buying rate. Foreign currency is considered as peculiar commodity with wide fluctuations price. The bank would like to sell immediately whatever it purchases, and whenever it sells, it immediately tries to purchase so that it meets its commitment. The main reason for this is that he bank wants to reduce exchange risk it faces to the minimum. Otherwise, any adverse change in the rate would affect its profits. In the case of spot deals, the transaction is quite simple. If the bank purchases any foreign exchange, it would try to find another customer to whom it can sell this and thus book profit. In this process, the profit would be the maximum because both buying and selling rate are determined by the bank and the margin between the rate is the maximum. If it cannot find another customer, it sells in interbank market where the rate is determined by the market condition and the market is narrower here. Example, your dealer in the dealing room sells through an exchange broker in the local market USD 5,000. Delivery is spot in cover of the telegraphic transferred from abroad. Calculate the rupee amount receivable from this sale assuming that the US dollar rupees rates are quoted in the local market as under spot USD 1 equals RS 42.8 thousand to 8,500 brokerage 0.01% solution. The bank sells at the market buying rates of RS 42.8 thousand. Rupee amount received on sale of USD 5 million at RS 42.8 thousand, RS 2 million for 14,000, brokerage payable at 0.01%, RS 2,140, net amount receivable on deal RS 213.97,860. Example A. A customer sold French franc 1 million value spot to another customer at Rs 0.5200 and covered himself in London market. On the same day, when the exchange rate were as under spot USD 1 equals FRF 6.5880 to 5,920, local interbank market rate for US dollars were spot USD 1 equals Rs 42.7 to 8,500. Calculate the cover rate and ascertain the profit of loss in the transaction. Ignore brokerage on the interbank transaction. Solution: the bank covers itself by buying francs or selling dollars from the London market at market buying rates for dollar. The requisite dollar is acquired in the local interbank market at the market selling rate for dollar against rupee. Dollar rupee selling rate equals Rs 42.8500. Dollar franc buying rates equals FRF 6.5880. Franc rupee cross rate 42.8500 plus 6.5880 equals Rs 6.5042. Franc is sold to customer at Rs 6.5200. The sale is covered at Rs 6.5042. Profit per franc sold equals Rs 0.0150. Profit on FRF 1 million at RE 0.0158 per franc equals Rs 15,800. Note, this rate has not been rounded off because no transaction is done at this rate, but it's calculate only the arrive at the profit. Trading. Trading refers to purchase and sale of foreign exchange in a market other than to cover banks. Transaction with a customer. The purpose may be to gain unexpected changes in exchange rate. In India, the scope of trading, although is still subject to control, it's getting wider, the relaxation being made in exchange control. Regulations. Example, your forex dealer entered in a cross-currency deal and had sold USD 5 million against Deutsche Marks at USD 1 equals DM 1.4400 for spot delivery. However, later during the day market became volatile and the dealer in compliance with his top management guidelines had to square up the position by purchasing USD 5 million against DM at the ongoing rate, assuming the spot rate are as under USD 1 equals INR 42.4300 to 4,500 and USD 1 equals DM 1.4440 to 4,450. What will be the gains or loss in the transaction? Your answer should be rupees. Ignore brokerage solution to square its position. The bank can forecast US dollar against marks at market selling rate of DEM 1.4450 per dollar. DEM acquired on sale of USD 5 million at DEM 1.4400 equals DEM 7,020,000 DEM. The fade on for case of USD 5 million at DEM 1.4450 equals DEM 7,022,500. Loss on combined deal in marks equals DEM 2,500. In terms of rupees, the loss would be the rupee outlay required to acquire DEM 2,500 from the market. The bank sells USD and acquires DEM at the market USD buying rate of them 1.440. The requisite USD it can acquired in a market at the market selling rate of Rs 42.4500. The mark rupee cross rate is 42.4500 plus 1.4440 Rs 29.3975. Loss on the transaction in rupees equals Rs 23.3975 times 2,500 equals Rs 73.494. Swap deals. Swap contract can be arranged across currencies. Such contract are known as currency swap and can help manage both interest rate and exchange rate risk. Many financial institutions count the arranging of swap both domestic and foreign currency as an important line of business. This method is virtually cheaper than covering by way of forward portion. Technically, a currency swap is an exchange of debt service obligation denominated in one currency for the service and agreed upon principal amount of debt denominated in another currency. By swapping their future cash flow obligation, the counterparties are able to replace cash flows denominated in one currency with cash flows in a more desired currency. A swap deal is a transaction in which the bank buy and sell the specified foreign currency simultaneously for different maturities. Thus, a swap deal may involve 1. Simultaneous for case of spot and sale of forward or vice versa. 2. Simultaneous for case and sale both forward but for different maturities. For instance, the bank may buy 1 month forward and sell 2 months forward. Such a deal is known as forward swap. A swap deal should fulfill the following condition. There should be simultaneous buying and selling of the same foreign currency of sale value for different maturities. And the deal should have been concluded with a distinct understanding between the bank that it is a swap deal. A swap deal is done in the market at a difference from the ordinary deals. In the ordinary deals, the following factors enter into the rates: the differences between the buying and selling rates, and the forward margin, the premium of discount. In a swap deal, the first factor is ignored and both buying and selling are done at the same rate. Only the forward margin entered into the deal as the swap difference. In a swap deal, both for case and sale are done with the same bank and they constitute two legs of the same contract. In a swap deal, it does not really matter as to what is spot rate. What is important is the swap difference, which determines the quantum of net receipt of payment for the bank as a result of the combined deal. But the spot rate decides the total value in rupees that either of the bank has deployed till receipt of forward proceed on the due date. Therefore, it is expected that the spot rate is the spot rate ruling in the market. Normally, the buying or selling rate is taken depending upon whether the spot side is respectively as a sale or forecast to the market maker. The practice is also take the average of the buying and selling rates. However, it is of little consequence whether the forecast or selling or middle rates is taken as the spot rate. Need of swap deals. Some of the cases where swap deal may become necessary are described below. 1. When the bank enter in a forward deal for a large amount with a customer and cannot find a suitable forward cover deal in market, recourse to swap deal may become necessary. Number 2, swap may be needed when early delivery or extension of forward contract is affected at the request of the customer. Please see chapter on execution of forward contracts and extension of forward contract. Number 3, swap may be carried out to adjust cash position in currency. This explained later in the chapter on exchange dealings. Number 4, swap may also be carried out when the bank is overbought for certain maturities and oversold for certain other maturities in a currency. Swap and deposit investment. Let us suppose that the bank sell USD 10,000 3 months forward. Instead of covering its position by a forward forecast, the bank may buy from the market spot dollar and keep the amount in deposit with the bank in New York. The deposit will be for a period of 3 months. On a maturity, the deposit will be utilized to meet its forward sale commitment. Such a transaction is known as swap and deposit. The bank may resort to this method if the interest rate at New York is sufficiently higher than the prevailing in a local market if instead of keeping the amount in deposit with a New York bank. In the above case, the spot dollar for case is investment in some other securities. The transaction is known as swap and investment. Currency arbitrage traditionally has been defined as the purchase of assets or commodities on one market for immediate resale on another in order to profit from a price discrepancy. In recent years, however, arbitrage has been used to describe a broader range of activities. The concept of the arbitrage is of particularly importance in international finance because so many of the relationships between domestic and international financial markets, exchange rate, interest rates, and inflation rates depends on arbitrage for their existence. In fact, it is the process of arbitrage that ensures market efficiency. The purchase of currencies on one market for immediately resale on another in order to profit from the exchange rate differential is known as currency arbitrage. If perfect condition prevail in the market, the exchange rate for a currency should be the same in all centers until recently. The pervasive practice among bank dealers was to quote all currencies against the US dollar when trading among them. Now, however, growing percentage of currency trades don't involve the dollar. For example, Swiss bank may quote the euro against Swiss franc and German bank may quote pound sterling in terms of euros. Exchange traders are continually alert to the possibility of taking advantage through currency arbitrage transaction of exchange rate consistencies in different money centers. This transaction involve buying currency in one market and selling it in another. Such activities tend to keep exchange rates uniform in the various markets. For example, if US dollar is quoted at Rs 42.4 thousand in Mumbai, it should quote at the same rates of Rs 42.4 thousand at New York, but under imperfect condition prevailing, the rates in different center may be different. Thus, at New York, Indian rupees may be quoted at Rs 42.4800 for dollar. In such a case, it would be advantageous for a bank in Mumbai to buy US dollar locally and arrange to sell them at New York. Assuming the operation to involve Rs 10 lakhs, the profit made by the banks would be at Mumbai US dollar for case 4 Rs 1 million at Rs 42,104,000 would be 1 million divided 42.4 thousand USD 23,584.90. Amount in rupees realized on selling USD 23,584.90 at New York at Rs 42.4800 would be Rs 1,001,887. Therefore, the gross profit made by the bank on the transaction is Rs 1,887. The net profit would be after deducting cable charges each incurred for the transaction, the purchase and sale of a foreign currency in different center to take advantage of the rate differential is known as arbitrage operation. When the arbitrage operation involves only two currencies as in our illustration, it is known as simple or direct arbitrage. Sometimes the rate differential may involve more than two currencies. For example, let us say that these rates are prevailing. Mumbai on New York Rs 42.4 thousand, New York on London USD 1.5100, Mumbai on London Rs 64.600, Based on quotation for dollar in Mumbai and for sterling in New York, the sterling rate in Mumbai should be Rs 60 64,250 while the prevailing rate is Rs 64.600. The bank can buy dollar locally and utilize it in New York to acquire sterling there. The sterling thus for case may be disposed of locally. Let us say the transaction is undertaken for Rs 1 million. Number 1. The bank buy dollar for Rs 1 million at Mumbai. Amount realized in dollar is 1 million divided 42.4 thousand USD 23,584.90. Number 2. The bank sells USD 23,584.90 at New York and acquire pound sterling. Amount realized in pound sterling at USD 1.5100 per pound is 23,584.90 divided 1.5100 GBP 15,619.14. Number 3. The bank sells GBP 15,619.14 at Bombay at Rs 64.600 and realize Rs 1,562. Therefore, the gross profit on the combined transaction is Rs 562. Such an arbitrage operation which involves more than two currencies is known as compound or indirect arbitrage currency or arbitrage transaction. Also explain why such profitable opportunities are fleeting. In the process of taking advantage of an arbitrage opportunity, the buying and selling of currencies tend to move rates in a manner that eliminates profit opportunity in the future. When profitable arbitrage opportunities disappear, we say that the no arbitrage condition holds. Summary and conclusion. In this chapter, we had introduced the student the major transactions involving foreign exchange transaction, namely the merchant transaction and interbank transaction. In the process, we have explained the reader and the determination of forward exchange contract and the rules involved in the computation of forward exchange contract. Also discussed is the various way by which the bank try to cover the foreign exchange transaction, bills, cover deals, swap deals, and arbitrage operation each. The student are advised to work out problem related to merchant transaction, foreign exchange contract, and interbank deals to get more insight in this transaction. Model question. Number 1. Your forex dealer had entered into a cross-currency deal in the interbank market and bought DEM 5 million against USD 1 equals DEM 1.5150 for spot delivery. However, the market turned volatile and therefore the squared up his position by disposing of Mark against USD dollar at ongoing market rate. Assuming Mark were caught in the mark as under spot, USD 1 equals DM 1.5250 to 5,300. 1 month forward, 1.5200 to 5,250. And if the spot USD 1 equals Rs 43.6300 to 6,450. In the local interbank market, what will be the gain or loss in the transaction? Your answer should be to the nearest rupee. 2. ABN Amro Bank Amsterdam wants to purchase 15 million rupees against US dollar for founding their Vostro account. Assuming the interbank rates are 43,3625 to 3,700, what would be the rate you would quote to foreign bank? Ignore exchange margin, brokerage each. If the deal is struck, what would be the US dollar amount that would be created to your Vostro account? Number 3. Your exchange dealer has an overnight oversold position in US dollar 3 million at Rs 0.43.6400. The following deals were done by him on the next day for case rate rupees US 1 million at 43,640 USD 15 me- ay 15 million at 43.65 USD 5 million at 43,66,375. Find out his position in dollars after these deals and his profit or loss. Ignore brokerage and telex charges. Number 4. You had booked a forward for KSTT covering an export bill for French francs 5 million at RS 6.40 due 25 April and cover yourself for same delivery in the local interbank market at RS 62.42. However, on 25th March, the exporter sought cancellation of the contract as tenor of the bill is changed, assuming the French francs were quote against US dollar in London market is under spot USD 1 equals FRF 5.6075 to 6,125. 1 month forward 90 to 95, 2 month forward 155 to 170, 3 month forward 245 to 260, and in the local interbank market, US dollar were quoted as under spot USD 1 equals RS 35.5825 to 5,900. Spot April 100 to 200. May 300 to 400. June 600 to 700. What will be the cancellation charges if any payable by customer, bearing in mind that you require 1. An exchange margin of 0.15% and 2. A flat charge or RS 100. 5. On 2nd August, an import customer of your bank requests you to book a forward contract for JYN 50 million. When market was an under delivery required September USDRE 35,3875 to 950 USD DPY 104.20 to 30 spot August plus 3 plus 6 spot August 00201 spot September plus 5 plus 10 spot September 00. However, on 31st August, customer wants to cancel the same contract. Market on 31st August is as under USDRE 35.3925 to 75. USD DPY 105.38 to 45. Calculate the amount to be recovered paid to the customer on account of cancellation, taking into account 0.15% margin to be loaded and cancellation charges to be recovered as per FIDI. Number 6. A customer comes to the bank with a draft for US dollar 10,000 drawn on the bank. The rupee US dollar interbank rate is spot USD 1 equals RS 37.70, 37.80. Calculate the exchange rate and the rupee equivalent payable to the customer. Rounding off as per FIDI rules. Exchange margin to be loaded as 0.080%. Number 7. A customer has approached you to issue a demand draft on New York for USD 50,000. The ongoing market rate is USD 1 equals RS 37.70, 37.75. 1 month forward equals RS 37.90, 37.95. Exchange margin to be loaded as 0.150%. Compute the rate to be quoted to the customer. An exporter consumer has present 60 days signed documents for USD 150,000 drawn under a irrevocable LC. The rupee USD rate in interbank market is as follows. Spot USD 1 equals RS 37.6050, 37.7050. 1 month forward equals RS 0.1500, 0.1000. 2 months forward equals RS 0.2800, 0.2000. 3 month forward equals RS 0.4000, 0.3200. Transit for the bill is 20 days. Exchange margin is 0.150%. Interest to be recovered at 13%. Calculate the rupee amount payable to the exporter. Number 9. What is meant by merchant rate? List some transaction involve merchant rates. Number 10. What are the modes of foreign exchange remittances? Number 11. What are the principal types of buying and selling rates? Discuss. Number 12. What do you understand by the term option forward contract? How does it differ from fixed forward contract? Number 13. Describe how forward rates are calculated. A. When the forward margin is at premium discount. B. For fixed forward and option forward contract. Number 14. Explain the circumstances under which a forward exchange contract can be cancelled by an authorized dealer.